when we spend a lot of time looking at how to evaluate decisions, we really are evaluating managers' decisions. It's important to understand the scope. A fundamental concept is we should only evaluate people on things that they can control. Can you imagine how frustrating it would be if somebody were to evaluate you based upon something over which you had no control whatsoever? It would be a significant blow to your morale. So as we look at what can people control, we've got just some terminology here. A cost center is simply an area of the company, a portion of the company where the manager can control costs, and that's it. She cannot control revenues. She does not control investment in infrastructure. All she's doing is controlling costs. It reminds me of my college job. As I worked my way through undergraduate school, I was a full-time deli manager for a local grocery chain. So I scheduled employees, I ordered food. I essentially was running a cost center. Now, don't get me wrong. The deli, I'm sure, did generate a profit for the business, but to evaluate me as the deli manager, it really is a cost center. I could control labor. I had a little bit of say in the labor rates. I didn't get to negotiate pricing with our vendors, but I did get to control waste, so unfavorable quantities. By ordering the right amount of perishable food products, I was essentially running a cost center, so I should be evaluated according to a cost center, and I was. Now, you could conceivably have a manager who is only evaluated on revenues. It might be somewhat unusual because we know that it can be dangerous to simply look at revenues. Think about, it's January 2019 as I'm recording this video, and I believe Aquaman has the potential to be one of the highest grossing box office films ever. Well, that's great for Aquaman. Lots of revenue, but that's only one half of the profit equation. We also have to look at expenses. So you could have a situation where a manager is held accountable for only revenues because they only control revenues. But be cautious and understand that the costs are part of that total profit picture, which brings us to a profit center. If a manager has control over the revenue portion of the income statement and the expense or cost portion of the income statement, then that manager really is running a profit center and should be evaluated as such. At the highest level of decision making, we have an investment center. So an investment center, you almost might think of the C-suite, CEO, CFO, COO, or at least very high-level people in the organization. The managers who are making decisions in an investment center are making decisions that affect not only revenues and expenses, but also the investment in infrastructure and other productive assets. They're making decisions like, should we remodel our building? Should we buy a new oven for the pizza restaurant? Should we expand to a third location, a fourth location? Should we buy a new van or should we fix the old van? So what you can see is, by understanding this terminology, it lets us design evaluation and compensation structures that align with what employees can control. Is it just costs? Is it just revenues? Is it the profit picture? Or is it the whole big picture?